Okay guys, so a warm welcome to this video looking at oil prices and how we use economic data in the US to get some trade ideas as to when we want to be buying oil or when we want to be selling oil in the commodities market. So this is very, very important if you are a commodities trader or even if you're trading the commodity currencies in the Forex market. This video will explain to you how you get an idea as to when you want to be buying the currencies or buying the oil price or selling the commodity currencies when the oil price is falling, because the two are very tightly correlated in the markets. The commodity currencies really do move in line with oil prices, and I'm basically showing you some economic data in the US, Europe and China that actually gives you an idea as to when the demand for oil will be rising or when the demand for oil will be falling, and that obviously has a big impact on the oil price, which is configured around the supply and demand equation that produces the price. So you're gonna love this. We create some Excel spreadsheets for you guys. You can take the download, you can update it on a week by week basis, and it will literally be telling you how the oil price is very, very likely to perform. And we're gonna go back in history and have a look at the tight correlation between the two. In the spreadsheets, you have the links for where you can get the data from. You can update the data yourself on a week by week basis. It's very easy, very simple, but it will make a massive impact on how you trade the commodity price and the commodity currencies when we're looking at oil in particular. So really excited to share this with you guys. I'm gonna go to the computer screen and I'll break this down for you in more details. Thank you. Hello traders, and welcome to our first video where we're now going to start to dig into looking at oil, what drives the price of oil, and how we can start to anticipate when there's going to be a rise in oil prices or a fall in oil prices before we start to analyze the commodity currencies that we want to start being exposed to, which trade in such tight correlation to the price of oil. So what we need to first analyze is, why does oil prices rise and fall, and how do we anticipate when we're going to have a stronger oil price or a lower oil price? And then how do we either directly trade the price of oil or indirectly trade the currencies that are so highly exposed to oil prices because their general economies are reliant on trade in oil for domestic growth? Now we're looking at the currencies Russian ruble, Norwegian krona, Canadian dollar for an example. And we start to analyze other currencies like the Brazilian real. And we look at the Australian dollar, the New Zealand dollar, and we look at some other commodities as well, and currencies, to get a better idea as to how to trade these currencies based around, again, commodity prices. So first of all, what we need to analyze is, who is buying oil? Who is the world's biggest consumer of oil? Because once we get a picture as to where oil is being sold to, if we get a view on that region of the world or that specific country, then we're going to start to get a better idea as to where oil prices are likely to go, being based around whether there's going to be a high demand for oil or a low demand for oil. So what we have to do is go to the oecworld.en, which is a really good currency. Sorry, oec.world is a really good website where you can do an analysis. You can literally go to the search bar, type in crude and get up crude petroleum, and then you can go into this website and do a deep analysis to where oil is being sold to. So what we need to watch is, who are the world's biggest exporters? And remember, the exporters are going to be the countries that are very exposed to oil prices. If oil prices are going higher in the markets and there's a high demand for oil, then these countries are going to benefit from higher oil prices and a higher demand, because more revenue is going to come into their country, and that means the currency is going to be in higher demand. And we see these currencies strengthen in the exchange rate during these periods of higher oil prices. On the flip side, if oil prices are falling in the markets, this is very detrimental to these economies because they've got less money coming to their country because the price of oil is falling in the markets. And then that means these currencies will weaken as a result. But first of all, what we want to establish is, who are the world's biggest oil consumers? So China is buying 18% of the world's crude oil. The United States is second with 16%. And if you go to continents, then we can see that Asia imports the world's crude oil, Europe second, and the United States third in 19%. And remember, Asian growth is driven by Chinese growth because China is the biggest economy in the Asian region. So if China's economy is growing, then the Asian economy is growing, and that means there's a higher demand in the Asian region of the world. And America drives global growth because America is, of course, the world's biggest economy. So if the United States is growing, the global economy is growing. And if the whole world is growing in terms of there being an economic expansion, then there's going to be a higher demand for oil as a result, because oil is a key commodity that is linked to the business cycle. So what we need to do, traders, is just start to analyze oil prices. Now, the price of oil is derived around two factors: supply and demand. When there's a high demand for oil, just like anything in the marketplace, prices will rise in value because it's a sought after commodity, a sought after product, and then as a result, prices rise. Then on the flip side, you have a supply equation where, of course, you have all these producers that are producing oil at the same time, all these countries, and you have an organization called OPEC, which is the oil producing, exporting countries that export oil. And these are basically a cartel that can kind of manipulate the price of oil by purposefully reducing the supply in the market whilst there is a high demand, meaning that prices will rise during periods of high demand and less supply. Or if they increase the supply, then you can bring down oil prices in the markets relative to demand. So what we need to understand, traders, is most importantly, if oil demand is going to increase, and then as a result, as the demand for oil increasing, we're going to see a higher oil price, how do we anticipate that? Or can I say on the flip side, if the demand for oil is going to decrease in the markets and oil prices are going to fall as a result, how do we anticipate this? So this is the key question. Now, if you've already looked inside of the advanced video course in the members area, then you would have known that ISM manufacturing is a key economic indicator that markets use to predict growth in the United States. Now remember, ISM manufacturing predicts growth with an 85% certainty because manufacturing makes up a key part of the US economy. And as we can clearly see here, we have a level of 50, which indicates growth or contraction. So if the ISM manufacturing report is above the level of 50, this is anticipating that there's going to be growth in the US economy. And remember, the US economy is the world's biggest economy. So if the US is growing, the rest of the world economy is growing. And then you have growth in Europe, growth in Asia, and a higher demand for oil. That makes sense. However, on the flip side, if the ISM manufacturing goes below the level of 50, this is indicating there's going to be contraction in growth, lower growth. And of course, as I just said, as the United States is the world's biggest economy, if the US economy is slowing, then the global economy is slowing. There's a lower demand for oil. As a result, oil prices fall. So we've clearly got a directional bias when we're looking at ISM manufacturing. If it's above the level of 50 and growing, then that means the US is growing, the world is growing, there's a higher demand for oil, we get higher oil prices. If ISM manufacturing is slowing below the level of 50, then clearly contraction in US growth, contraction in world growth, lower demand for oil, and then we have a lower oil price. So as we can clearly see in this graph here, which is depicting ISM manufacturing highlighted in blue, and then we have GDP in the United States highlighted in red. And then what we can see is we can clearly see as the ISM manufacturing starts to fall, you have lower levels of GDP growth. And then when ISM manufacturing starts to rise above the level of 50, then we have higher levels of GDP growth. And in 2008, when the financial crash happened and ISM manufacturing dropped below the level of 50, GDP dropped below the level of 50. When ISM manufacturing went above the level of 50, GDP peaked above, peaked back out of contraction and started to show growth. And we've been in a growth situation ever since. A few troughs below 50, but nothing meaningful and nothing long lasting. So clearly we can see the ISM manufacturing and GDP growth in the United States really do trade hand in hand. And this is why ISM manufacturing is a leading indicator predicting whether the United States is going to grow or contract over the next 6 to 12 months. So it predicts growth in the United States over the next 12 months and has done this with an 85% certainty since 1948 when the data was first being released. So why this is so important to us traders is because we first have to analyze how we know when maybe a downturn in economic growth is going to turn around, or an uptrend in economic growth is maybe going to turn lower. And we look at the peaks and the troughs of ISM manufacturing. So if ISM manufacturing is below the level of 50, contracting, showing slow growth in the United States, and it troughs, and what it means by troughs is, let's say it grows at, let's say ISM manufacturing is going below the level of 50, we go from 46 to 44 to 42 to 41 to 40, but then the report comes out from 40 and then it goes back up to 42. This is showing that the ISM manufacturing has troughed and that the economic downturn in the United States may have come to an end, and we are expecting some growth to occur in the economy over the next 12 months. So when we see troughs in ISM manufacturing, this is indicating the slowdown has stopped, and an upturn in economic activity is highly likely with an 85% certainty. And it's in these situations that we anticipate the demand for oil is going to increase, and we should expect in the smart money to start to plug money into the commodity currencies, or start to buy oil prices, because they're anticipating that ISM manufacturing indicator has troughed and growth is expected to continue over the next 12 months. And we've seen this happen many times when it goes below the level of 50 and troughs, then it comes back above the level of 50 and we get growth in the economy. Each and every time this happens, we see the same pattern play out where it troughs, comes back higher, and we have growth after that. So if we actually go ahead, traders, and look at another spreadsheet where we look at oil prices and the ISM manufacturing on top of each other, now you're going to start to see how the ISM manufacturing literally is a leading indicator for the price of oil. So look at ISM manufacturing in blue, and we have oil prices highlighted in orange. So when ISM manufacturing drop below the level of 50, indicating a slowing US economy. And remember, a slowing US economy means a slowing global economy. That means there's a less demand for oil in the markets. Oil prices are going to be falling because of this lower demand. And that will give us an idea as to how the commodity currencies are going to trade as a result. So ISM goes below the level of 50, and look how much oil prices slump straight away as oil prices go below the level of 50. And then ISM manufacturing troughs, and then it starts to pick up. We're still not at the level of 50 because we're still below 50, so there's still contraction in growth, but it's growing. The economy in the US is slowing at a slower rate, so growth is now starting to come back. And look at oil prices immediately start to rise and follow the ISM manufacturing, and we get this huge trend in oil prices. So you can clearly see how they really closely move together, pretty much hand in hand. And again, ISM manufacturing starts to slow from its peak. So again, we looked at troughs. So when the ISM manufacturing troughs, this show growth is now starting. And when the ISM manufacturing peaks above the level of 50, so it goes to its highest level and then slows for the first time, this is indicating that that the economy may have got to its peak. It can't grow any faster than the rate it's already growing at. And in this situation, as we see, when ISM manufacturing comes lower, we get oil prices dropping lower. So it's exactly the same for the troughs and the peaks. I just want to show you in this graph. When we trough, we're betting growth is going to come back. And when we peak, we're betting growth is going to subside because it can't get any better than than the level of growth that's already in the market at that time. So again, we use the ISM manufacturing oil to look for peaks in ISM manufacturing and troughs in ISM manufacturing to anticipate when a long-term trend is going to build in oil prices. And you can clearly see here, traders, the oil and ISM manufacturing pretty much move in exactly the same direction when it's above 50 or below 50. So again, just remember, when ISM manufacturing is above the level of 50, there's growth in the economy, and we're expecting a higher demand for oil. When ISM manufacturing is below the level of 50, there's contraction in the US economy, and we're expecting oil demand and oil prices to go lower. And what we really want to look at is the level where we get the peaks and the troughs, so we can get in the beginning of a trend and we can really pick up when oil prices start to rise. Now, on the flip side, traders, you may be looking at a market when ISM is above the level of 50, but if it's above the level of 50 and growing, then the US economy is growing, the world economy is growing, and oil prices should follow as well. And that's a situation where you want to be buying oil in the markets. And then when ISM manufacturing peaks and starts to slow, you're betting that the US economy can't grow any faster than it already is growing at the moment. And we're betting that oil prices will start to slip lower. And that's exactly what we see here with oil prices going lower. And again, over here, when ISM peaked and started to go lower, so did oil prices. So you can really see, look how tightly correlated these two indicators are when we're looking at ISM manufacturing oil prices, which is perfect for us because now we get an idea as to how do we bet on when growth is going to be growing in the United States, or how do we bet when growth is going to be slowing in the United States. And all we have to do is look at the ISM manufacturing. If it's above 50 and growing, the world is growing, oil prices are rising because there's going to be a high demand for oil. Great. When ISM manufacturing is below the level of 50, we know the US economy is slowing, the global economy is slowing, there's a lower demand for oil, oil prices are likely to fall, then we have a short bias towards selling oil and selling the commodity currencies as well, which is perfect for us traders because now we have an indicator that we can use to anticipate oil prices. So that's phenomenal. And again, if you look at the advanced course, we know how to get the data, we know how to fill it in. So just go have a look at the advanced course and you can see how we get the data and how we continuously update our charts. But what we must now do is to see how, now we know that how to anticipate the global economy is growing. It's also important that we anticipate how maybe China's economy would have an impact on oil prices, because as we've seen recently in the markets, wrong chart, wrong page. We've seen oil prices slumping aggressively recently as the coronavirus outbreak has really gripped the world as I record this course. And this all started in China. And we now need to do an analysis on China because remember, China is the world's biggest oil importer, as we just saw, importing 18% of the world's oil. So if at any point China's economy starts to slow, then automatically we know that oil demand is going to be lower because again, China is the world's biggest importer of oil. So that's very important for us to understand. So what we need to do is we need to basically have an analysis on who does China trade with and who does China rely on for their own domestic growth. And once we get that bigger picture, we'll have a world view by looking at the US economy. Is the world growing? Is the world contracting? But if something ever happens in China where China's economy starts to slow, we already know that China is the world's biggest oil importer. So if China's slowing, then that means oil prices fall in price because China, of course, is importing the world's most crude oil. So what we've seen here is, if you're looking at where China's selling their goods and services to, yes, China does export 44% of their exports to Asia, but we can't look at analyzing Asia to get an idea as to growth in China because Asia completely relies on growth in China for its own regional growth. So Japan, South Korea, the Philippines, for an example, these countries are highly dependent on growth in China for there to be a high demand for their exports and China to consume a lot from these countries and help these countries grow. So we have to look outside of Europe, and we can clearly see that America is buying 25% of all Chinese exports and Europe is buying 22% of all Chinese exports. So this gives us a good idea that if the United States is growing, then automatically China is growing and Europe is growing because Europe's main export markets is the United States and China, but China is completely dependent on growth within the US for the global economy to grow. And if the global economy is growing, then Europe's growing, and then China's main two trading partners are going to be causing Chinese growth moving forward. So same as ISM manufacturing, what we want to look at here is Chinese PMI data, which is Chinese manufacturing data. And this is really important because this gives us a view on Chinese growth moving forward. And similar to what we saw with the ISM manufacturing, we can do the same for Chinese manufacturing. So when we see Chinese manufacturing dip below the level of 50, what do we see? We see an aggressive sell-off in oil prices. And once once the PMI manufacturing in China troughs and starts to rise, we see oil prices start to rise at the same time. When it peaks and goes lower, we see oil prices going lower. And we can clearly see how these two are very, very tightly correlated in the markets for PMI data out of China and oil prices. But most importantly, I just want to show you so you can see the correlation. But we don't need to really monitor this one closely. The main one is ISM manufacturing, because if China is relying on trade with the United States for its own growth, then clearly we just have to have a view on the United States to get a view on the world. And once we get a view on the world growing or contracting, we get an idea as to the level of demand for oil prices. So traders, that's how we build an analysis on looking at the leading economic indicators. So looking at ISM manufacturing to get a view on the world. And once we get our view on the world, we have an idea as to if there's going to be growth in China, growth in Europe, growth in the United States. And if we do have growth in these countries, then we know we have a high demand for oil. And that's when we want to be looking at buying oil prices based on the ISM manufacturing indicator in the United States. It's so important for us to watch, so important for us to monitor. If we monitor it well and we keep up and we stay on top of this data, we'll get good trade ideas for oil. Now again, we're going to go look at all the commodity currencies, but look how closely correlated some of these currencies are to the price of oil. Let's look at Russian ruble, very highly dependent on oil exports. We're going to do a separate video analyzing oil and the Russian ruble, but look, when we see, for an example, the euro against the Russian ruble, when oil prices are falling, the euro is rising against the Russian ruble. And then as soon as oil prices start to rise, the Russian ruble strengthens against the euro. And you can see there's a very, very tight correlation between the Russian ruble and the euro and oil prices. So again, the euro is rising against the Russian ruble, and this is because oil prices are falling. And then as soon as the oil price starts to rise again, the ruble strengthens against the euro. And you can just see there's a very, very tight correlation. And again, an even stronger correlation when we look at the US dollar against the Russian ruble. Again, when we have a look at here, we have a stronger US dollar against the Russian ruble as oil prices fall. And then when oil prices start to rise, we have a stronger Russian ruble against the US dollar. For an example, then when the US dollar starts to rise against the Russian ruble, this is in correlation to oil prices falling. And we can clearly see they're pretty much inverse to each other. Same situation for the US dollar against the Norwegian krone. You can see here, when oil prices are falling, the US dollar is getting stronger against the Norwegian krone. And when the Norwegian krone is getting stronger against the US dollar, this is because oil prices are rising. And again, we're going to do an analysis on the Norwegian krone at the same time. I'm just giving you an overview as to how oil prices really do affect the commodity currency. So again, traders, what we need to do, if you just go to the advanced course, go to the sources, download the spreadsheets, you know where to update the ISM manufacturing data from. You can download the spreadsheets, update the spreadsheets, but all we need to remember, to get a view on oil, we just have to have a view on the world growing or contracting, and the US is the world's biggest economy. So we just need to have a view on the US economy to have a view on the world. And if the US economy is growing, oil demand's increasing. If oil demand's increasing, oil prices are rising, and then we want to be buying the commodity currencies. On the flip side, if the US economy is slowing, the world is slowing, lesser demand for oil, lower oil prices, and we want to sell the commodity currencies. And remember, when it's below the level of 50, this is signaling contraction and slower growth in the United States. We have a sell bias towards oil and the commodity currencies. When we're above the level of 50 and growing, we have a strong bias towards global growth increasing. We have a higher demand outlook for oil. So we want to be buying oil, buying the commodity currencies because they're going to appreciate in value. And we have to pay attention to the peaks and the troughs. So when ISM is slowing, and then it troughs for the first time and starts to pick up, we're anticipating growth is going to come back. And this is the time where we want to be looking at going long in the commodity currencies. And when we peak above the level of 50, and it basically signals that the US economy can't grow at any faster rate than it's already growing at, and the only way is down in growth, then we have a bias towards selling oil and selling the commodity currencies because demand for oil can't go any higher than it already is in the markets. So traders, hope that made sense. That's our first video analysis looking at oil. But we now understand US economy drives global growth, but we always must pay attention to China because China is the world's biggest oil importer. And this is why when the coronavirus hit China in early January 2020, oil prices slumped by 34%. Because if China's economy, whilst China's economy, was in lockdown, and Wuhan and many of these huge cities in China with 85 million population, and each city was in complete lockdown, then the factories, the aviation industry is in lockdown, and that means there's a lower demand for oil from China. And because China is the world's biggest importer of oil prices fall in value. So really interesting, really important to get a good view on the United States as the world view, but also have an idea as to China towards our view. But also we need to always pay attention to America, because China relies on growth in America for its own domestic growth. And we already understand that Asia relies on China for growth. So you get the bigger picture. If the US is growing, the world is growing. If the US is slowing, the world is slowing. And then we have an outlook on the price of oil based on the demand for oil. So I hope that makes sense, traders. And that's my analysis for oil. Thank you.